Wanting to start an S Corp because you want the benefit of saving thousands of dollars in self-employment tax? This is a really popular trend going around right now that all sorts of online creators are sharing. The thousands of dollars in tax savings that you can receive by forming an S Corp. Now, the important thing that you need to understand is that these videos are being created by online creators who are sponsored by companies that are forming S Corps. So while an S Corp does have a potential to give you a big savings in taxes, it also can be a very costly mistake. Online creators that are sponsored are not sharing with you the hidden and quite expensive costs of forming an S Corp. So I want to break it down for you so you understand and can make the best choice for you and your business. If you file the additional paperwork with the IRS to elect S Corp taxation status, then you're going to be required to hire yourself as an employee of your own company. This means several different additional expenses, such as payroll costs for either hiring a bookkeeper or getting a payroll software, staying compliant with your state's employment laws, which oftentimes includes getting workers' comp insurance, which can be an additional monthly expense. Now, once you've hired yourself as an employee, then you are going to break down your income into two different ways of receiving that income. This is going to be paying yourself a reasonable salary and giving yourself the remainder as a distribution. Now, you're required to give yourself a reasonable salary, so let's just go ahead and put 50% into your salary and 50% into a distribution. From that salary, you're going to be required to pay payroll taxes. This is going to be that Social Security, Medicare, and other expenses. Your distribution is not subject to payroll taxes, and it's not subject to self-employment tax, which is the big tax savings here. You're going to save 15.3% in taxes on what you receive as a distribution. Now, the next expense here that is never covered in these other videos is the QBI deduction. This is the qualified business income deduction, and it allows owners of pass-through businesses to claim a tax deduction worth up to 20% of their qualified business income. Now, you can only claim this on the amount that you receive as a distribution, not on the salary portion, which means only 50% of your income here is going to receive that QBI deduction. Now, if you're a sole proprietor or if you are an LLC that did not file S Corp taxation status with the IRS, you are defaulted to a pass-through taxation status. And if you're an LLC, you're what's known as a disregarded entity. You equal your business in terms of your business income taxes. All of the income that comes into your business is yours, and you will pay yourself using an owner's draw, a simple transfer from your business checking to your personal checking or writing yourself a check. Now, this then means that all of your self-employed income is going to be subject to federal and state income taxes, and all of that income is going to be subject to self-employment tax, which is 15.3%. And that tax is going to be applied to 100% of your net income. Now, 100% of this self-employed income qualifies for that QBI deduction. So you are going to see a difference here between the amount of your income that qualifies for the QBI. So filing to have your business taxed as an S Corp means a lot of different changes for your business. So before you do this big change for your business, there are some very specific things that I want to make sure that you understand. Yes, this can equal big savings, but it also can equal way too many expenses that you are not ready for. So first, before you file, check and make sure, can you handle the extra expenses? Payroll, running payroll, all the expenses associated with that, like workers' comp and staying compliant with your state. Can you pay yourself a regular, reasonable salary? Is your business income stable and steady and large enough to pay yourself that regular salary? Next, what are the things you're going to need to do to stay compliant within your state and your state labor laws? Make sure that you fully understand those obligations. Next, does the change in the QBI deduction outweigh the tax savings from self-employment tax? The only way to know this for sure is going to be to consult a tax professional. Getting information from trusted sources on TikTok and YouTube can help point you in the right direction of ideas and useful information. But if you are thinking about switching to an S Corp, make sure you consult with a tax pro.